We're talking money all week here on UTTV. So now let's answer some of your credit questions. I'm joined by Mr. Credit himself, Derek Evans. Welcome to Primetime.
Great to be here.
This is your first time.
So, it is. First time on Primetime.
So honored to have you.
Yeah, appreciate it.
So we have some questions, I guess, but before we get to the questions, let's talk about the co-signer subject, and we'll get onto the commingling.
Sure.
So let's talk about that kind of stuff.
Okay. Yeah, well, I mean, it's funny because people make the exact wrong mistake. So people are more apt if they're a husband and wife or a boyfriend and girlfriend to co-sign on loans. Co-sign on a car note or co-sign on a loan. And that's something you should do only if you absolutely have to.
Like if it's your kid.
Well, even that's a bad idea.
If you have an irresponsible kid, it's a bad idea.
It's a bad idea no matter what, because bad things can happen, and you are just as liable as a co-signer as you are as a signer. So it's something you only want to do if you absolutely have to. However, commingling your assets or putting your money into the same bank account is actually a really good idea, and most people don't do that.
Before you get to that, let me ask you, if you co-sign for something, would it bring down your credit score?
It could. If they miss a payment, that's part of the risk.
But even that, like if you went to go get another loan, they would see that you had this debt that you were responsible for.
Precisely, which is why you may not qualify for that loan.
That's what I'm saying.
Even if someone else is making the payment. So you are taking
Paris,
on
I
liability.
just got you out of, you know, when your kids come to you and ask you to co-sign on a car or home.
Tell them I said no. Tell them Mr. Credit said I can't do it.
Go get your money yourself, kid.
Mr. Credit said no.
Okay, now let's talk about the commingling of money. And we're not just talking about, because for me, I have savings accounts for my daughters.
Sure.
And they've got pretty good money, but it's all attached to my credit. Like they can't open it their own. It's attached to my checking account.
That's a good idea. That's a good idea.
Is that commingling, or is that not what you're talking about?
No, what I mean by that is, you know, spouses a lot of times have separate accounts. They keep their money separate, and that's a very bad idea because it allows for people to do things that aren't good for the family. You know, if you're a family, if you're married, or if you're just boyfriend and girlfriend, you live together. You know, you're sharing everything. You're a team, and there's no secrets on a team.
So you think even if you're living together, you should have one account?
Well, if you're living together and you're that committed, you should mingle your assets. And here's the reason why, too. This is the key.
Boy.
Accountability.
That would make me nervous to
let
let some man into my bank account. I'd be like, what?
Well, if you don't trust him.
I work hard for my money.
If you don't trust him,
Jeez.
don't live with him.
You're just getting hot in here talking about sharing things, but sharing your money. I'm just kidding.
If you're not willing to do that, don't move in with him.
You're right.
That's my advice.
Yeah,
but
you're right.
you commingle the assets. It's a good move because it creates accountability. So it forces you know every dime he spends, you're going to be able to see it. Every dime you spend, he's going to be able to see it.
Yeah, but he can wipe you out like that.
Well, he could, but that's exactly the reason.
Could you do like a baby trial, like checking account together where there's only X amount of money, so if he decides to clean you out, or she, you're only losing X amount?
You don't commingle everything.
Right.
You don't commingle everything. You're talking about your expenses, you know, the money that you make on a regular basis, not savings accounts and things like that, or retirement accounts. There's no point in that. That's what you have a trust for.
You're not hanging everybody.
No. You can't put the risk
Jump
out
off
there
the
like
cliff,
No.
Okay, so, and you're saying by commingling that you'll be able to see how they're spending their money, but does it raise your credit score when you commingle?
No, it's not about raising credit score. That's about creating accountability for your budgeting. You know, because people will spend money, they'll go to the casino and spend a couple $100. They think they can get away with it, or they'll buy stuff they shouldn't buy if no one's watching them. You know, and so it's good. It'll keep people from doing things. They'll think twice before he pulls that $200 out of the ATM.
What do you typically see? I would bet that women would typically spend more money on shopping than they're supposed to. And I would bet that men might spend more money going out drinking or gambling.
Yes.
Am I right?
You hit it on the head. Yes.
Football games.
Football games, going to sporting events. But guys like to buy stuff too. There are plenty of guys out there who like to go and shop and buy clothes and have 20 different jackets or 50 different suits.
There's guys out there like to shop. I gotta meet those guys. Are you kidding me?
Yeah, they have the same problems. But you know, gambling is definitely a big problem. We see that, and having the commingled assets can really help prevent that.
Okay, what other tips do you have?
Well, a lot of stuff right now. I mean, you know, we're talking about. I think I heard you guys talking about real estate earlier. I think we need to get back to the basics on real estate and talk about the reason why we buy real estate. Now, there's a reason we buy real estate. People have forgotten it. Do you know what the reason is?
I don't.
Okay, the reason is because it's part of your retirement plan. The whole point is you buy a house because one day you don't want to have to pay for your housing. You want to own it free and clear and not have a payment on it. But everybody's so worried about buying at the right time and getting everything exactly right.
I think that the new trend in thinking is getting money, investment money from your home, flipping it at the right time and using that money as your retirement.
Exactly.
Not that you're ever going to pay off your house.
But you got to live somewhere. So the whole idea behind buying a house is to purchase a house so that you can one day not have a payment on it, so you can own it. That's a part of your retirement
what
plan.
about making money on the most profitable real estate and taking that equity and then buying a smaller, because when you're older, you're going to downsize anyhow, right?
Yes.
And then you can buy something off that. Does that work?
You can. I think that planned downsize and upsizes are bad planning, because if you unless something changes in your life, you should be able to get the house that's good for you for the long run, the first time, the right time. If you're willing to make a couple sacrifices, put a couple bunk beds in for a few years or something like that, you shouldn't have to buy and sell so much real estate in your life. It costs a lot of money. It's 8 to 10%. Every single transaction.
Yeah, but so for me, I have a house, 5 bedrooms, because I have 4 daughters. Well, I'm not going to need those 5 bedrooms someday, so that doesn't really apply to me.
Well, yeah, exactly. So in that situation,
Unless I adopt a bunch of kids, which I might.
you could.
I could.
But you may want to downsize
Right.
at some point in time, and when you do, that'll be very easy to do. Downsizing is easy. Upsizing, not necessarily the case.
Right, it's not. You're right. And where do you see real estate in the near future?
We see real estate having a good year. I was fortunate enough to listen to the economist, the chief economist for Freddie Mac speak, who nailed his speech back in 2011. And he says real estate prices will go up this year, 5 to 8%. And we will see low interest rates, sub 4% for the rest of the year as well.
Really?
Yeah.
So I don't have to be freaked out about refining my house, because I'm paying really low interest right now.
Yeah, you don't have to be worried about it at all, and that's the beautiful thing. If you get a good rate on a 30-year fixed mortgage,
But
you don't have to worry about prices.
But mine's not fixed, it's adjustable. So for people like myself that are in adjustable loans, when do you think they should think about refinancing?
Right now.
See?
Yesterday.
Really?
Yes, right now.
And tell us why.
Because the Federal Reserve has stopped the bond buying program that's just keeping mortgage rates artificially low.
They stopped it.
Yes, so there's $1 trillion allocated towards it. There's only like $40 billion left, which means it's almost over.
So what's the time frame? How long, at what rate will it be over?
A couple of months, and they'll be done. Maybe a month and a half, and they'll be done buying bonds, which means that all of a sudden, your big buyer of mortgage bonds that's keeping rates low is going to be out of the game.
And then will they slowly go up, or will it be a big jump?
It could be a pretty quick move, but I don't think they will allow it to get past 5%, but you're seeing sub 4% stuff right now. You need to take advantage of that.
That's good advice, folks. That is very good advice. Okay. We're going to wrap, but is there one more valuable tip that you could give our viewers?
Yes, there's one thing that everyone can do to improve their credit, whether you have 800 credit scores or you have 550 credit. Get yourself a secured credit card. If you got great credit, it'll help protect, create a little force field around your credit profile. And if you don't have good credit, it's probably because you don't have any open, active trade lines. So that's one thing that everyone can do to either help or protect
break
their
it
credit.
down to our viewers. What is a secured credit card?
It's a credit card that the bank gives you based on your deposits. So you give them $250, they give you a credit card with a $250 limit. So they have no risk, but you have a credit card that reports to the credit bureaus and improves your credit
And
score.
that's a good thing for kids getting out of college, going to college. That's great.
Absolutely. Get all your kids on that so they don't need you to co-sign.
Thank you.
All right,
And we
thanks a
hope
lot.
to see more of you here.
Appreciate it.
Thank
Thanks, Taylor.
you. Great tips. Okay, we got to take a quick break. Prime time. We'll be right back.